now over 3 years since I first started warning that there is something seriously going wrong at Tesco, Britain's supermarket giant, and that stock investors should take a note and sell out. At what was then a stock price trading near its all-time high of £3.83. At the time I was criticised for basing my views purely on anecdotal evidence. However, as experienced investors know, that to truly understand how a company is performing, one has to experience its service and products firsthand as a consumer. And so in a series of articles starting October 2013 and spanning more than a year, I warned that Tesco was seriously lacking when it came to customer service, in that its demoralised and underpaid staff were going out of their way to put shoppers off from capitalising on their various offers, such as spend £40 and get a £5 off your next £40 shop voucher. In fact, several months before my first Tesco article, I actually wrote to Tesco management warning the supermarket giant looked set to face a crisis as poor real customer experience meant they were going to hemorrhage big spending customers. But all I got back was a bland reply that failed to pick up on any of the points I made that would prove to be harbingers of what was to follow. And so the Tesco share price entered what could best be described as a death spiral, and despite hitting bottom at £1.37 has since underperformed the FTSE, as revelations of just how badly the supermarket giant has been run went from bad to worse, from its debt black hole to outright accounting fraud. So now in this series of videos I will attempt to evaluate if Tesco has finally turned the corner or not. In my last video I explained why Tesco and the rest of the already depressed retail sector was facing a perfect storm of rising prices, falling consumer disposable earnings and hemorrhaging customers to the discounters, all of which will culminate in increasing pressure on profit margins and balance sheets. Whilst it is still too early to imagine another Woolworths moment, i.e. a retail giant going bust, nevertheless there will be an impact which will at the very least translate into more job losses and probably the mothballing of many unprofitable stores, the closure of huge supermarkets, something that is unthinkable to most will likely become a reality, so as to bolster profit margins by cutting costs by closing supermarkets that are no longer able to operate at a profit. One of the primary places to look for the degree of retail sector distress is at the stock price charts. For whilst the FTSE has been setting new all-time trading highs, then clearly relative underperformance shows the degree to which a stock is in distress. The further the deviation from its trading high, then the greater the distress the retailer is experiencing. Tesco by far ranks as Britain's #1 retailer in terms of sales of over £54 billion, more than twice its nearest rival Sainsbury. The Tesco stock price says it all of just how badly run Britain's supermarket giant has been for many years, which goes beyond the usual dynamics of a badly run businesses that overexpanded during the good years. For you know when a company is in deep trouble when the Serious Fraud Office has been investigating it for several years. And whilst the fraud is estimated at £326 million, however, when it's all done and dusted, it could deliver an even bigger shock to Tesco's finances. A mega fine of upwards of £500 million that could be the nail in Tesco's coffin. At £1.87, the Tesco share price is trading at less than 50% of its 2013 high. That's a 50% loss of stock market value over the past 4 years, valuing the supermarket giant today at just £15 billion. I'm sure many inexperienced investors out there looking at the 50% collapse in the Tesco share price might be imagining, how cheap is Tesco now? Well, £1.87 won't be very cheap if it halves in price again, or worse. Tesco's valuation is now less than its estimated debt mountain of £16 billion, resulting in a debt to capital ratio of 75%, and its P ratio is at an eye-watering 60 times earnings. That's what many dot-coms trade at, which would be fine if Tesco was a dot-com, which it's not. And for comparison, Sainsbury is on a PE of just 11, whilst Morrison's on 22. However, there is even worse news for long-term Tesco stockholders, for the stock peaked at about £4.75 in 2007, so long-term investors will be lamenting on a whopping 60% loss in value. This whilst the FTSE has been setting all-time highs, says it all at just how big a basket case Tesco has become. And just as I began warning over 3 years ago, Tesco has literally been in a downwards death spiral that has taken the stock down to £3.50, then £3, then below £2.50, and now languishing below £2 as it eyes revisiting a sub £1.50 stock price. As for investors looking for a dividend, then they need not bother, for there is no dividend. So whilst Tesco's revenues have already fallen from 64 billion a few years ago to 54 billion for 2016, as the supermarket giant continues to hemorrhage customers to other major competitors and the discount retailers, preying on the supermarket giant like piranhas feeding on a dying whale. And when companies find themselves in trouble in terms of losing revenue and market share, then they tend to double down. So when faced with the prospects of further contraction in revenues, then the name of the game is to artificially boost revenues and market share through acquisitions via debt-fueled purchases, to give the illusion of revenue and market share stability. So it's no wonder that Tesco is showing signs of panic, as illustrated by its recent purchase of Booker, owners of Budgens, for £3.7 billion at a 20% market price premium. Despite the fact that Tesco already had a huge debt mountain before this £3.7 billion purchase, the message the purchase is sending out is that Tesco management are seeking to diversify away from the mega stores towards smaller convenience stores, including supplying independent corner shops. And in terms of my personal experience of shopping at Tesco stores, then whilst the large network of stores means that Tesco is by far the most convenient of all supermarkets for most shoppers, which tend to be well stocked in terms of product range, however, Tesco loses all of the advantages due to the lack of adequate staffing, especially in the evenings, and prices tending to be at least 5% higher than the likes of Morrison's, and this without taking into account the recent disaster of the BBC exposing fake shelf prices that fail to convert at checkouts. My Tesco big shops have over the time become far less frequent, probably now averaging 1 in 5 shops of over £200, which means Britain's supermarket giant is likely to continue to suffer and lose market share to its competitors such as Morrison's, as big spenders increasingly shop elsewhere. So is the Tesco stock a buy today, trading at less than half its 5-year high? Well, I'm sure many investors staring at the long-term charts would imagine they could pick up a stock at a 50% bargain. However, given the fundamentals and in terms of probability, the Tesco stock price is clearly more likely to trend lower than higher during 2017. And therefore, another 50% drop is more probable than the stock doubling, at least for the next couple of years or so. So no, I will not buy or hold Tesco at current prices, as you will likely be able to buy one Tesco share and get one free in the not too distant future. In terms of specifics, therefore I expect Tesco to break below £1.50 and eventually trade to below £1 a share, which would translate into a 50% drop on the current price. So despite Tesco management's desperate actions, a tough 2017 is likely to see a continuation of the Tesco crises for at least another year, especially considering that the serious fraud office are not done with Tesco yet, and as a consequence of which will likely be hit with a massive fine, the news of which will send the Tesco stock price plunging once more. Therefore, taking into account Tesco's current distress and at least another year of pain, and I would estimate the probability of Tesco going bust at some point during the next 2 years at about 33%. What you think is impossible, never going to happen, well, I'm sure holders of Lehman Brothers stock also thought so, whilst it went from a value of about £500 billion to zero. Whilst Britain's banks were bailed out, nevertheless investors typically lost 90 to 95% of the value of their stock investments. And leaving aside the banks, there are many other examples of megacorps going bust. Remember Kodak? Well, that went from a value of about £25 billion to zero. So when a mega stock is clearly in severe distress, then never say never. Of course, if worst comes to the worst, Tesco could be deemed to be too big to fail, and the government could step in to bail Tesco out with taxpayers' money, just as it did for Britain's banks. But that won't save stock investors from being wiped out, as were bank stock investors. My next retail sector crisis video will take a look at the prospects for Britain's second largest retailer, Sainsbury. So ensure you're subscribed to this YouTube channel for that analysis, as well as for other forthcoming major UK retailers.